Thank you very much, Razia, for that very comprehensive and insightful keynote into the African economic backdrop. My name is Bridget Uku, and I'm investment manager at the London Borough of Ealing. As an African living in London, it really gives me great pleasure to be moderating this session. I will introduce my panel in a minute, but maybe I should just sort of talk about some of the broad issues that me as an asset investor sees about Africa. Africa is really at the dawn of an economic boom. It gives a lot of promise, but for us asset owners, there is still a lot of uncertainty. There is still a lot of opacity and very little visibility. It's very hard to assess the risks and the returns and whether your returns will be rewarded. And from what Razia has just said, it's obviously very clear that it's not a monolithic land and that there's loads of differences and lots of pockets of opportunities, lots of challenges. So I hope that the panel will be able to expand on some of those issues today. So my panel here, I have with me to my left, to my immediate left, David Cowan, who's African economist at Citi Research. Razia needs no introduction. She's already been introduced. I've got Ravi Bhatta, Director and Regional Expert, Standard & Poor's Sovereign Ratings Group. And to my far left, I've got Matt Robinson, Manager, Africa Sovereign Ratings Team, Moody's Investors Service. So firstly, I think it'll be useful for us to probably start by having my panel give their opening perspectives. So maybe starting with you, David.
I've probably got to switch this on, actually. Sitting here thinking about what I'm going to say. You can probably hear me anyway, so it doesn't really matter. I don't know, is that on? It's on? Okay, good. You can all hear me. Okay, look, I think the most interesting graph, for me, I enjoyed Razia's presentation. I think it's what her and I have been arguing quite a lot, generally in a sort of a broad sense, right? Demographics are a hugely important driver of growth in the continent. There are a lot of misconceptions about the continent. But I actually think that the graph that was most interesting, and certainly for this audience, and what they should pay attention to clearly, is the savings investment graph that came towards the end. And I think that actually is a really interesting issue. Yes, we do see signs that infrastructure has been overcome in Africa, but I think that fundamental gap between Asian savings and African savings is the key issue that has to be addressed here. Now, whether we buy that Asian savings are somehow structurally higher because there's a greater urge to save in Asia, we don't know, or whether, if you looked at the graph a little bit and where Razia had that the African savings rate was picking up in the mid-2000s, was a response purely to very high interest rates on the continent at the moment, which tells us there is really just a rational monetary response underneath it. As interest rates have come down, perhaps people haven't saved as much going forward. So I think that is very interesting. And then I think you need to look at that savings rate as well in relation to the fact that although this is a consumer story, what we're seeing in Africa, we are seeing the consumer coming under pressure in various countries at the moment. I think that's very interesting too. So I think that is the graph. And what it ties into is a grand thing that perhaps the rating boys will talk to afterwards. But what we have in Africa is we have growth, we have change, but perhaps yet the structural change underneath is not as great as what we thought. And in particular, Reza alluded to it, the lack of growth in the manufacturing sector, I think, is crucial in this and crucial in demographics. And for the manufacturing sector to grow, there needs to be this improvement in infrastructure, I think, is the key driver. Now, with that savings rate, that infrastructure is going to have to be funded either by external borrowing, or there's going to have to be a fundamental way of change in the way that African governments raise revenue so that they can then fund it and increase their revenue share. That, I think, is the battle that will run at the heart of what's going to go on in this continent in the next 10 years and will be the decider of whether Africa is really going to manage to break out of that low growth. Now, you as the pension industry are going to be at the center of that. And I think the center of it is actually going to be, as Razia referred to this, what happens when the US raises interest rates and how we're going to think about monetary policy in Africa going forward. Will it have to normalize? Will rates have to go up to attract that savings that allows that investment? Or, as we're seeing interestingly at the moment, the pressure on a lot of central banks is actually to push interest rates down. Now, the reason they're doing that is because their fiscal positions are in slightly delicate places at times. They're spending too much on debt servicing costs, they feel, so they want to push the rates down. Whereas I look at it slightly the other way. What they really need to be doing is getting their revenue growth going back up again to offset that. So I think that is the core of the policy debate, which you, as a pension industry, are deeply involved in, because you are also going to provide some of that money. And as a base, what you really have to think about is that without this growth in manufacturing industry, we're not creating enough formal sector jobs. And formal sector jobs are the people who pay largely into the pension funds that you are going to manage, right? And so you have to achieve that. Now, look, I was in South Africa on Friday, and the key issue that comes out of South Africa is it's a country with 25% unemployment, right? Probably even higher. That's just the official stats, right? So let's think about that, right? If the rest of Africa is going to have these huge unemployment rates because you're not achieving the structural change, you're not going to see the flows that you want into the industry going forward. And so I think that's where this whole core debate comes in. You are part of it. Can you mobilize savings? Can the governments create enough formal sector work that people pay into it? And can they get the monetary policy right to encourage those flows to come into you? I think that will be where the crucial element is. So I think the next decade is kind of partially your decade in that growth outlook.
Thank you. Ravi, your opening observations.
Thanks. Well, I slightly disagree with some of the points that David has made. In particular, I don't really see, that we have to have this manufacturing boom in Africa. The costs are very high. I think a whole-scale transformation where you see Africa becoming the next China is not going to happen. It really is closer to what Razia mentioned, that basically these are consumer-driven economies. They're a blend between consumer-driven and commodity-driven. And actually, manufacturing is the small piece in the equation. And I don't think that is that it's going to fundamentally change, or actually that the government should really be pushing for a fundamental change there. There are many economies that have grown very nicely based on domestic demand and the consumer sector and the middle class growing nicely, and on the flip side, commodity exports. There are many models like that. For example, India, for instance, is basically consumer-driven, services-driven, and manufacturing remains a very small part of the equation. It's very different from the China model, where you have this massive manufacturing sector, and it's the engine, the producing engine of the world. And in fact, at this stage, with the dominance of China, I don't think Africa really stands a major chance in the manufacturing space. But that's not all bad. Basically, what we're seeing is that, politics in general have become more benign in Africa. I mean, they're not all going to be, sterling democracies. But basically, politics has become more benign and more stable. This has permitted institutions to strengthen broadly across the board. Of course, there are exceptions. As we mentioned yesterday, there are over 50 countries in Africa. And there's always the exception, CAR, etc. right now. But by and large, politics has become more benign. The institutional and structure has improved. The macroeconomic management has improved. And that's been very important to permit this basic middle class and consumer growth engine to kick off. So that's sort of driving it, and it's fine. On the flip side, of course, there's the benefit of the strong commodity boom that benefits. And again, as Razia mentioned, the 7% growth in China is absolutely fine. The question to that is, in the next few years, is whether U.S. shale oil will significantly impact oil prices going ahead. But there are enough pockets of demand in the world, well, not pockets, but large areas of demand in the world that should keep commodity prices high, and also tied to the ongoing instability in the Middle East, should keep the commodity picture fairly sound. So that's sort of the way I see the growth story. Now, looking at it from a credit point of view and a credit risk point of view, we're seeing actually that this trend of consumer-led growth actually, apart from the big oil producers, Angola, Nigeria, Gabon, etc., where basically what's happening is we're seeing a sucking in of imports, both consumer imports and capital goods. Now, it's not a bad thing, but basically it's pushing current account deficits up. which need to be covered on the external side. And also, because it's consumer-led and you're having more cars on the road, etc., there's this pressure on infrastructure. So governments are finding themselves in a place where they have to spend more money on projects. Also, there's a greater demand from the more vocal middle class for social spending. So we're seeing actually fiscal deficits going up as well. And these are twin risks that are posing themselves against that good growth story. And if you look back, Africa got a round of HIPC debt relief. We're looking at from the early 2000s to about 2006-07. But basically, and then in 2007, around 2007, debt levels actually were quite low. But now we're seeing a ramping up of these debt levels. And it's been quite easy because of this environment of low interest rates and the attractiveness of emerging markets. So money's been flowing in. But whether that is going to sustain alongside this rising debt levels and the vulnerability on the external and both fiscal side is a sort of short to medium term concern. I think I'll stop there.
And Matt, your
look, fantastic macro backdrop provided by Razia, David, and Ravi as well. So it's difficult to come in and add more to that. I guess perhaps what I might do is take a slightly different track and look a little bit more narrowly at sovereign ratings. I guess from your perspective, they're in and of themselves an asset class, but also they set the benchmark. They set where a lot of the banks, the corporates, borrow at, ultimately flow through to equity prices and affect the investment decisions. Not just of pension funds, but more broadly investors in the region. I guess our view of the sovereign credit quality perhaps takes a little bit along the lines from Razia's perspective. Quite a positive growth story there that is supporting the credit quality of a lot of African sovereigns. Now, African sovereigns, by their nature, in their level of development, a lot of them populate the lower end of our rating spectrum. We only have 4 investment-grade sovereigns, Botswana at the A2 level, and then in the BAA category, South Africa, Namibia and Mauritius. Most of the African sovereigns are lower down in the spectrum. You're talking about the BA3, B1 level, where you see a large congregation. And these are driven by some of the longer-term constraints that exist. Ravi, David spoke about it in great detail, some of the infrastructure bottlenecks that prevent the growth potential from being realised, some of the institutional constraints that weigh on the confidence investors can have that they're going to be repaid their money on time and in full, control of corruption, rule of law, respect of contracts, etc. But there's still this very positive growth story there. You are seeing that in countries like Côte d'Ivoire, where you're seeing almost double-digit growth rates. Some of the smaller economies like Sierra Leone, heavy mining investment, DRC as well. These countries have very positive growth stories, not just from the commodity perspective, but also Nigeria, for example, from the domestic demand perspective. That positive growth story is providing that impetus or that favourable view on sovereign credit quality. We see that reflected in the positive outlook that we have on Côte d'Ivoire at the B1 level. We recently upgraded Angola to BA3, having had it on positive outlook for quite a substantial period of time, reflecting that growth in the petroleum production, the growth in the economy. I think Razia, you showed it, one of the stellar performers in the Africa space in terms of expansion in the economic size over the last 20 or 30 years following the settling down of the conflict. So that positive growth story is providing this support for sovereign credit quality that is reflected in a lot of the positioning of these ratings and ultimately the corporates and banks that lie under those sovereign benchmarks as well. They're getting greater access to finance. I think from the negative side that everyone has focused on, there are these fiscal issues that are out there. We see them quite acute in in countries like Ghana, running quite large fiscal deficits. We see it also in South Africa, perhaps a little bit of backtracking on some of the institutional improvements in the South African space as well. Both of those sovereign ratings, they're the two negative outlooks that we have in the sub-Saharan Africa region. I guess if we're talking about the North Africa region as well, some of the domestic political constraints informing some of the negative outlooks on Egypt, also Tunisia as well. Morocco, we've recently stabilised the outlook. Those fiscal issues are going to become more challenging in an environment of Fed tapering, in an environment of global central banks withdrawing some of this easy money that has been around. And those fiscal challenges, if they get worse, obviously could drive greater downgrades. That would obviously have a flow-through effect to the ratings that are achievable for banks, for corporates, their ability to access finance. So I guess that's an area that we really need to concentrate on, see those that have their fiscal house in order. I think, Bridget, you were alluding in your initial comments to the issuance prospects going forward. Those sovereigns that have their fiscal house in order, you can expect to see them still having good quality access to finance and the ability to issue debt in the marketplace, international marketplace that is, not just relying on their domestic sectors. That should free up the ability for corporates, for banks to be able to finance also in the international space with a benchmark, but also prevent the crowding out, the government's not crowding out the access to finance from a domestic capital market perspective. We expect to see more pressure, though, on some of the sovereigns that don't have their fiscal house in order. Ghana's one of the ones that stands out, even though it was able to issue a global bond earlier this month, had a much higher yield than they've had to pay in the past. You're also seeing some of the fiscal deterioration starting to come home in places like Zambia, Uganda, where there's very strong pressures on government administrative spending. Not so much on some of the countries like Mozambique or elsewhere, where you're seeing a lot of the investment channeled towards growth-enhancing capital investment. And that's probably the places where you'll next see the level of issuance perhaps coming to market, generating a benchmark curve upon which a lot of the other sectors, a lot of the other asset classes can price off.
Okay, thank you very much. So maybe I can go back to looking at or delving more into this growth story in Africa and how sustainable it is. Because I think Africa suffers from what I would probably call the BBC syndrome, where a lot of the growth in Africa is actually just put down to a resource boom that's not going to be sustainable, it's very dependent on China. Let's look at the China-Africa relationship. Is it one that's sustainable, where China gets the resources and Africa, and then in turn they go and develop the infrastructure? Long term, is this a sustainable relationship? And does it need to evolve over time?
If I can come in on that, I think there are a few things I need to address, especially in Ravi's comments about, does Africa actually need manufacturing? Does it need to move on from this place of primary commodity dependence? The problem with that is it's okay to be a commodity producer when commodity prices are supported and everything in the world is fine. What we do know is that for many countries, it's that issue of being single commodity dependent or dependent on just a few commodities that causes great problems ahead. As much as you may be very benign in terms of fiscal management and you're saving all the surpluses, there will still be this shock to growth, which can hit very hard in the event of a commodity price collapse. So I think for that reason, if not for some of the reasons that David alluded to, the formal sector employment growth, how do you actually generate the tax revenues? What we have seen in Africa is a good example of services sector growth, but so much of it is informal economy. It's a very difficult distinction in the services sector, especially to go from informal to formal, and that just doesn't help when you're looking at revenue mobilization. So it's part of the China-Africa debate, and I'll let the other panelists come in on that. But I think a few key things. Commodity dependence, continued commodity dependence is not really going to be the way forward for Africa. There has to be a lot more. Diversification is always healthier. In terms of China's relationship with Africa, it's been about a lot more than trade. Africa now has the surplus with China, so that's positive. There's been a lot of talk of China as the Robin Hood economy. It takes away from the rich countries and it gives to the poor countries, and it's been doing that in Africa. But there's also this demand to make that relationship more meaningful and not to expect that Africa will just never have manufacturing of its own.
Anyone have anything else to add?
And I would say what you want to add to that is that really China is also perhaps arguably the future of Africa. Look, right, we know what's happening in Asia. Labour costs have been bid up. Chinese manufacturing industry has shown some very provisional signs of relocating to Africa. We've seen in Ethiopia, I have a picture I haven't been carrying around with me that I picked up of a lovely new shoe factory in Ethiopia that employs thousands of people, right? But I think that it's not just that, right? I think Razia's slides hit on the point, right? Africa can feed Asia. Asia is a land-poor region, right? And it's about growing food and then processing it in Africa and shipping it to Asia, right? That will also provide employment for you. So I think that relationship going forward is going to have to just keep solidifying. But it will change and it will transmogrify. But that is the key, how it changes and how it transmogrifies. And that's quite uncertain at the moment, is all I can add to it, right? There's a great deal of uncertainty about it, but it will evolve.
Yeah, just on that. I mean, don't get me wrong. Manufacturing is, of course, a very good thing. The problem is that the costs are high in Africa. The size of the individual countries are not big enough to really sustain commodity manufacturing of scale, apart from Nigeria, of course, and South Africa. But basically, so there are many hurdles to a manufacturing base. Infrastructure costs are high, transport costs are high. So obviously, we would like to see lots of manufacturing, but that's not the way this model is evolving. The reality is that these economies are looking in a best-case scenario, more like a Canada or an Australia, where you have a blend of commodity exports with a service-size economy. You know, it's a blend and some manufacturing. But they're never going to be full manufacturing powers, at least not in the near future. I mean, that's some years ahead. And I think in the current atmosphere, yes, of course, there's the reliance on a few key commodities is bad. But given this very large China sucking in commodities, it's not necessarily a bad thing for Africa. Oil prices will hopefully remain high, and there's an export avenue there. But that's not to say that the rest of the economy has to develop. But most of it will be through domestic demand. Service sector will continue to be the big sectors. If you look at the rebasing of the Nigerian economy recently, look what zoomed up in size was services. Services are now 50% of the Nigerian economy. And what shrunk was agriculture, and manufacturing also, as a proportion, shrunk. So you're seeing the dominance of services and consumer-led, and it's not necessarily a bad thing.
Let's take this forward, right? Your earlier argument was we've got growing current account deficits in Africa, right? And rising fiscal deficits, right? Now, how do you stop that? You have to get exports rising is the only way to bring in your current account. Otherwise, what happens? Either you do a CD, and your currency collapses on you completely, or you do a South Africa, where the currency hasn't collapsed, but you go back to low growth. Because you can't keep funding this and borrowing debt, right? It has to end somehow. So somehow you either got to kickstart exports in a low commodity environment, or you let your currencies adjust, which may be Africa's way forward, right? That you just let your currencies smash through the floor, so then you become competitive to overset your structural high costs. But otherwise, you're going to be like South Africa, stuck in low growth.
With the currency depreciation option, the problem is you look terrible to potential lenders. Nobody wants to put money into a country with a collapsing currency. You're not able to afford all of the imports to improve your infrastructure. That's the more perhaps important constraint in African competitiveness. So I think what we're really saying is, yes, we've been in this model and it may have worked and it works for some developed countries, but is it really a solution for Africa?
Yeah, and I would say that what you don't want to do is to do a Ghana and let your currency collapse at the end of it. What you have to do is to be foresightful and think, how can I drive a weakening of my currency that will feed through gradually to improve my competitiveness over time? I think this is a big fundamental question for monetary policy in Africa. I think monetary policy has reached a point where our macroeconomic performance has improved. We've stabilised our exchange rates. They're no longer one-way bets. The kwacha was always depreciating. Everything was always depreciating. Now, how do we engineer our currencies to go forward? Maybe to give us a competitive advantage, or we offset it and have other competitive advantages by investing in infrastructure. I think we're at a really crucial point in trying to get this debate going forward.
Perhaps I can bring Matt in. Okay,
just one comment before Matt. I think these are all valid points, but the reality is Africa's not a manufacturing power. Basically, there's some manufacturing in South Africa, but where is it across the rest of the continent? And as it just shows, when David said he's got one picture of a shoe factory in Ethiopia, I mean, it's not exactly the workshop of the world. So to say that, I mean, it's a bit of a wish list to say, yes, we want to transform Africa into a manufacturing a giant, and it may happen some 20 years from now. But I think in the going up to that in the medium term, we're really looking at the kind of structure, and we have to deal with the risks that we have.
Yeah, I think, Matt, I need to go back to something you said in your opening remarks, which is about underdeveloped institutions. Now, before we can go forward to become a manufacturing giant, we really need to see developed institutions which can support all of these. And where are you seeing any improvements in institutions? I think that's a key thing. We cannot become a manufacturing continent until we have the institutions and the support network.
Yeah, that was going to be one of the points that I was going to touch on. Was manufacturing in and of itself would be good. It relies heavily on foreign direct investment. And you need to bring in the skills, the resources, the investment from elsewhere. This is not something that can necessarily spontaneously be created from an indigenous perspective. And so attracting foreign direct investment is a key to achieving this transformation that Razia, David are talking about. What are the constraints on foreign direct investment? Now, I mentioned a few of them before. Control of corruption, rule of law, respect of contracts. Those are the kind of things that really matter from an investor's perspective. You're seeing on some of the World Bank governance indicators some improvement in the sub-Saharan African space. There's a few standout performers. Zambia is one of them that has increased markedly its ranking from relatively low higher up. There's a couple of others as well. There's a few that you see some backtracking on, South Africa being one of them. There's a few that are a little bit more stagnant, that have remained stagnant for a fair while. There's some of the less developed ones, those that are still going through challenging domestic political situations or conflict. But providing that level of or the impetus for reform from a regulatory perspective, from a government transparency perspective, from a rule of law perspective, judicial perspective, that institutional improvement is what's going to be the precursor or allow for foreign direct investment, more foreign direct investment to come in. Taking one slight backtrack on this argument about China, one thing that we don't seem to touch on very often is China is very important to the African landscape. It has grown to be equal or on par with European trading partners, but it's still on par with, and Europe is one of the issues that it constantly ignored. Now that we see the European economy starting to grow, it's no longer in recession, starting to see the European demand for African exports improving. When we see a return to more normal growth rates in Europe, those economies that are more linked to Europe, your Angola, Mozambique, those ones that have stronger linkages from those perspective, less so the linkages to China, you'll see perhaps stronger growth rates there as well.
Okay, I'm conscious in the interest of time. I'd like to open questions up to the audience. If anyone's got any questions, if they can say who they are and say if they're directing the question to a particular member of the panel.
I was quite intrigued about the debate on manufacturing between China versus Africa. Yes, cost, all that. But one thing that quite strikes out as an observation is Africa has all the minerals. It's got agriculture. So basically you have all the raw materials in Africa. Botswana has done something incredible with the diamond industry, where they're doing some value-added diamond polishing in the country. I mean, do you, as a panel, do you think that this is something where Africa has a unique advantage compared to China? Because China needs to import everything if they need to, manufacture and sell it back into the continent. Perhaps, this is where you could actually have slightly more expensive manufacturing, but when you take into logistics consideration, infrastructure cost, the challenges behind all of that, it might be worth perhaps looking at that way and saying, yes, we are going to do value-add manufacturing where we have the supply chain behind us.
One way to look at it is in terms of labor costs. We know that Africa is already more competitive than a lot of places in China. It actually will benefit some Chinese companies to get engaged in more of that offshoring. So David mentioned Ethiopia. Yes, everyone looks to Ethiopia, but we forget those pockets of manufacturing that have stayed in place. In places like Kenya, for example, a fairly static share of GDP over the last decade, 2 decades, that in itself is an achievement. The question is, looking at the changing structure of the world economy, how are we going to see things change? What China needs is a source of commodities, yes, but also a vibrant market for its own exports. It is in the interest of every single trading partner that African countries have, that they do see this diversification of their growth, that they do see the beneficiation of their minerals, that they do see more value addition happening domestically. That will ultimately sustain a stronger African growth story.
Let's switch this around a little bit. Think of this in another way. Look, what we know, if we look at global growth, and the reason we focus on manufacturing is not really because that's all we know about. We don't really know of other sectors that have really managed to provide employment in the short term. So we have a model of how countries grew historically, and we think about it going forward. And Ravi's right, India has shown it slightly differently, but that's still the issue. Look, I would say to you, this idea that there's no manufacturing is actually nearly irrelevant, right? You build an export processing zone, you stick up a shed in it, you plug a whole bunch of people into sewing machines, right? That can be done very quickly, you make a lot of money very shortly. The FDI is kind of minimal, versus investing in agriculture and in mineral projects that have 10, 15-year projects. You need the structural resources, you need everything around it. That will happen. And we know that, finally, I think we know that the incidences of manufacturing growth have become shorter and shorter over time, right? So if you think Britain took 100 years to industrialize, France took 80 years, Germany, Japan took 50 years, China's taken 20 years, and it's nearly starting to deindustrialize on itself already. So Africa's will be very short, but it may provide a short-term fix in terms of jobs. And then you'll see the other sectors, agriculture, mining, adding the beneficiaries that will go with it afterwards, right? That's how I would sort of see it, right? It's going to be but it'll be a short period like that. And I think perhaps that's the solution to it, because otherwise unemployment will be an issue on this continent.
Yes, you raised the case of Botswana in particular, and I happen to be the Botswana analyst at S&P. Botswana is actually struggling on the value add to the diamond sector. As part of their new extension of their contracts with De Beers on the Jwaneng mines, they forced De Beers to put some of their diamond cutting, etc., in Botswana, because actually, if you look at it from the cost perspective, these diamonds were being mined in Botswana. Immediately, they were out of the country, being cut low end in India, high-end in the West, in Antwerp, etc., and then being sold on to the global market. And the success of Botswana didn't come from the value add in the diamond sector. It actually came from they managed the wealth that they got from the mining and redistributing it across the country, spending on education, spending on social welfare, and it's a sort of mini sort of Scandinavia in Africa, if you could put it that way. And actually, the growth sectors, apart from diamonds, have been the consumer sector, where it's been an add-on, if you like, of South Africa, with this booming consumer market. So again, the model was not one of manufacturing. Having said that, I mean, as I make the point, manufacturing, it's great to have it, but it's not happening that way. It's just not happening that way. So this model is slightly different, and I think it doesn't matter, because ultimately what you want is you want strong growth, which Botswana delivered for many decades. Okay, now they have new issues, but they did it for several decades. They transformed their GDP per capita from one of the poorest countries in Africa to over $8,000 now, or even higher. So the point is they managed in this manner to transform the economy entirely. And now, if you look at Kenya, okay, Kenya is one with a so-called big manufacturing base. Still, the biggest exports are commodities. You know, tea, coffee. Horticulture is a new commodity that came in, and again, it's consumer-led driven. But that's fine. Again, it's growing at 5.5%. We're looking at, so that's fine. It's transforming the economy.
Thank you. Can I just probably move the discussion into something completely different? And I think it's something that we must have in this panel session, and no panel session should be covering Africa as a whole, should not ignore the Ebola crisis, which is currently unfolding in parts of West Africa. Who is currently affected? Is this thing being contained? And where do you see this going? Anyone?
Maybe I can kick off if that's all right. First and foremost, this is a humanitarian crisis. The loss of life that you see, it's more than 1,000 deaths that have occurred in the three most affected economies, Sierra Leone, Guinea, and also Liberia. Now, first and foremost, this is a humanitarian crisis. We need to be sympathetic from that perspective. But also from the macroeconomic perspective, what does it mean for those economies in particular? This is a very significant impact on the way of doing business, with a lot of the borders being closed. They're porous, but they're still closed. The extent to which you can travel within these countries, bring produce to market. If you're a farmer in some of the outer areas, being constrained and not being able to bring your produce to the major capital cities for fear of the workers being contaminated with these issues, that has a very significant impact from a macroeconomic perspective. I think perhaps the bigger impact that we're likely to see on the growth rates of these three economies in the coming year is whether or not it starts to affect the mining industry. Now, Sierra Leone grew at, 16% last year on the back of significant mining investment production. If you see the Ebola crisis start to affect some of those mining areas, if you see withdrawal of some of the expatriate staff, if you see some kind of hindrance of the indigenous population, if you see anything that prevents the ability to continue to invest in these large-scale mining productions. We saw ArcelorMittal earlier this year call force majeure because one of its contractors wasn't able to deliver on part of the expansion. And what that meant was the entire mining expansion was shut down. Now that's just one subcontractor within a broader expansion that can have such a significant flow-through effect. So those three economies are the ones that are obviously being watched the closest. I think from the broader Africa perspective, though, what really worries us, what we look at from a more global perspective is whether or not sufficient investment is being made from a global perspective to try and contain the crisis. If this gets to, say, some of the larger economies, Cote d'Ivoire, Ghana, or worse still, Nigeria, one of the largest, sixth, seventh largest oil exporter in the world, if you see those industries start to be affected by the Ebola virus, then you'll see very significant impacts on the African growth prospects.
If I can just add to that. I think, yes, Matt's made very good points on that. And it's really had a major impact on especially those three economies. Nigeria's response was very fast and I think quite good, with, unfortunately for the Sierra Leoneans, shutting down the air links, etc. But I think what's missing here is really the Western view of this, because especially the Europeans to come to the table, because Europe takes the lead on global climate change and views itself as sort of the soft power with looking at humanitarian issues, but it's been very much, this is a problem for Africa, and the response has been very muted. But this is fundamentally a global problem. Right now, it's very much contained because the flights have stopped. It's contained to those three countries, but there's a chance that it could spread much more widely. I mean, there was a case of it moving to Nigeria via the airplanes. And I think in this, Europe should really have stepped up to the plate more on this. Obama and his administration came fairly late to the table, but now has acted with sending troops, etc. But I think it's a global problem and a global concern, and we need a global response.
Okay. How much time do we have? Not much. Okay. We probably have enough time for one more question. Any burning question from the audience? No? Any? No? Closing perspectives?
If I can just add one closing perspective, Bridget, maybe aimed a little bit at the first question, and a comment that Ravi made, which I think is very interesting. There's a bit of a policy conundrum here for African governments. How do they introduce policies? How do they amend policies to encourage domestic value added, whether it's in the manufacturing sector, whether it's elsewhere, it doesn't matter. But how do they do that? I think Botswana was an interesting example. Zambia as well is one of those interesting examples where you see the government, relatively new government coming into power, enacting policies with the best intentions in terms of trying to encourage and require domestic value add in the copper sector, requiring indigenous smelting. All that really achieved was prevented exports from occurring at all, and you saw quite a significant impact on the copper sector in Zambia, and they ultimately backtracked on that policy. And so you've got an interesting conundrum where you're trying to develop the local economy, you're trying to generate the revenue so that you can invest in the infrastructure that is necessary, and also to pacify some of the demands of the population for greater spending on social welfare and poverty alleviation. And yet you can't kill the sacred cow in doing so, because that is where you generate a lot of your revenue from.
Okay, I've got one more question from the audience. If you say who you are and who you're directing the question to, if any.
Thank you. It's the name is Vivina Berla, and I work with Sarona Asset Management. And the question that I have, and really any of you can pick it up, we have heard about the interaction between Africa and China, Africa and North America, Africa and Europe. I was curious to hear what you see in terms of the south-to-south trade from other countries, and let's take Latin America, India, Middle East, because it seems to me that there is a lot of untapped opportunity there, and that the recognition by those economies of realities that are familiar with, and the fact that the perception of risk from those countries is very different from the one that might be present in North America and Europe is very relevant. Thank you.
Okay. Razia?
Okay, so yes, a very good point. We've been talking a lot about China-Africa engagement because in its scale it surpasses anything that we've seen recently. But there's also been a very important trend of Africa trading more with other emerging regions and getting a lot more investment from those regions. What are the key differentiating points? Whilst China's trade with Africa has of course been very commodity focused, what we're seeing in terms of investment is quite telling. We're all aware of the numbers that Malaysia is, in fact, a more significant investor. Whether that's got a lot to do with Mauritius or the rest of Africa proper still needs closer examination. Indian corporates finding an environment that is very much like the one they know at home. The infrastructure deficits, the conditions of those economies, a lot of parallels with Africa. So finding in Africa an operating environment where they're quite comfortable, and that has been a very interesting feature. We expect that investment to grow. There are other considerations, of course, driving other elements of that South-South trend, but you raise a very important point. It can't be seen in isolation. I think a key takeaway here is that compared to other regions, Africa has tended to trade a lot less with itself and a lot less with other countries, to the extent that that is now changing. There are greater complementarities. We're seeing that investment into African agriculture. We're seeing the investment from the Middle East into African banking. It is broadening, it's diversifying, it's fundamentally better news.
Just if I can add to that. Yeah, I think we're seeing it across the board. It's not only China on the table. India's always had had trading links with East Africa for a long time, and those are stepping up. On the other side, Brazil and big investments in Angola, the Lusophone and the other Lusophone countries. So it's not only China; it's across the board. But I think what's missing is the intra-Africa trade. It tends to be limited to the country next door, and it pretty much stops there. And there's a lot of scope for intra-Africa trade which hasn't been picked up, and that's a lot of it is tariff barriers and infrastructure bottlenecks. But I think we're going to see that change over time as well.
Yeah. So it appears like I can conclude that Africa has a lot of promise. I think we need to see more economic integration across countries, especially where you have very small economies within Africa. I think when you have that, then you have more, you can attract more foreign direct investments. I think Africa definitely needs to have better economic policies, stronger institutions. Even if you attract foreign direct investments, you need to be able to police those operating those. I think we need a vibrant civil society, and we need the rule of law. Thank you very much for listening to this presentation. And thank you to my panel.